All right, folks. We have a very special treat for you today. This is the PetroNerds podcast. This is episode 33, and my guest today is the one and only David Ramsden Wood. I believe you like to call yourself by DRW. I still have you in my phone as David because I also have DRW. We can talk about that momentarily. But today is Sunday, November 7th, 2021. And I like to timestamp these podcasts with oil prices because it's very important of like, oh, what was it then when they talked about that? So on Friday, November 5th, oil prices from the Bloomberg terminal were 81.27 for WTI, 82.74 for Brent, and nat gas was about 5.50. That's really important because we are going to start off on a few different topics, and we're going to have some fun with this one because I'm sure DRW needs no introduction. But we can sort of talk about a little bit. Do you have a preferred title other than you run Hot Take of the Day? You have people know you well from your podcast. A lot of people know me from the podcast of being on your podcast from January. So I thank you for that.
Oh yeah, no problem.
Yeah. So this is
Trisha, I don't really. It's good. By the way, it's good to see you. Thanks for the invite.
It's good to see you as well.
No, I don't really have a title. I'm sort of like the Symbol, the artist formerly known as Prince, which I'm not comparing myself to Prince, but it's like DRW is just so much easier than David Ramsden Wood, and then broadly across industry, I think it's how it's known. And as you know, it's a bit of a caricature of the real David, and so DRW is probably my stage name. So we'll go with that. No, and no title. The Hot Take of the Day has been a lot of fun. It's great to see the world change and evolve. And I mean, I can't, as you know, I can't believe oil is 81 and gas is 550. But here we are. I couldn't believe that oil was negative 37 and gas was $1.50 either. So it turns out it works out.
It turns out it does, whether we like it or not, and whether things are going correctly. But my middle name is Jean. I could just start a TJC, Trisha Jean Curtis. I'm just going to start going TJC and DRW podcast.
TJC in the house. It's going to take about 7 years to get the brand recognition, but then in 7
absolutely.
years,
That's all. It only took. I started PetroNerds in 2016, and it's only taken until now to really go crazy. But with that, we have a hard stop in like 45 minutes, and David and I talk a lot, and we'll be packing a lot into this. So I think he said on his podcast with me, if you play it back on slow speed, you'll have about 12 hours of intel. So that's probably going to be the case here. And we have four big topics I want to do. I want to follow on just because of what's going on in the market and of what sort of happened last week. I put out a little Twitter video and LinkedIn video on a market rant and covered several things in this market rant. But inflation, investor pressure was sort of one of them. And in my last podcast with Mark Rossano, we talked about inflation, investor pressure, and didn't get quite in this investor pressure, which is really actually the two things. You've put out some posts on inflation, and I've really wanted to talk to you about that as well as investor pressure. And there's a great way to start this podcast because Energy Secretary Granholm failed to talk about that when she was interviewed on Bloomberg. So we're going to talk about Secretary Granholm's comments on Bloomberg, which are I just think absolutely ludicrous, and this woman needs to be taken to task, and I'm happy to do that. Investor pressure, inflation, and then we're going to talk about the jobs report, which all these sort of things meld together. And I know David is very comfortable with all these topics, so I don't think I'm throwing anything out of left field. So this. I was catching up on the news, and I was literally just watching, and I had to repeat it and watch it twice because I was like, is she laughing? Like, so Secretary Granholm is being interviewed on Bloomberg on, I think it was from November 5th, and she's in Glasgow at COP26, and she's literally laughing as these questions are being asked to her very seriously. And I think it's interesting that she's laughing because Democrats just lost, hand over fist on Tuesday in an election night, and a lot of analysis of that is people saying it's a rebuke of a lot of the policy measures of the big progressive moves. And I think one of them is inflation, and price is everything. And oil prices are having a big factor in that. I was just in Pennsylvania. I was in a community that doesn't have this is not a wealthy area, and inflation and oil prices are a big part of what people are feeling. And Secretary Granholm's comments were, when they asked her, it was started out with, what can the U.S. do to address this problem at home? What can the U.S. do to address it? And she laughs and says, she laughs and says, "This is oil prices or oil's not has nothing to do with U.S. This is about this. It's controlled by a cartel. It's called controlled by OPEC." And just completely negates the fact that the U.S. is producing 11.3 million barrels per day and was producing nearly 13 million barrels per day just 2 years ago.
I mean, it is truly remarkable, and I did a post on that this morning because it's really struck me, and the fact that, I mean, Biden did the same thing, right? I think on Sunday, first from, I think he was in Rome at the time before he was headed to Glasgow, but I think he said something along the lines of like, "Please OPEC, pump more oil so we can drive to and from work." And then Secretary
his
Granholm,
third major plea. Yes.
yeah, and Secretary Granholm is like, "No, we can't control it." And so I will say, I mean, clearly we've got where we are for a lot of reasons. We're here because of systemic underinvestment over the last 18 months because it wasn't profitable. We're here because E&P companies have now decided, as they should have done in 2018, to prioritize debt repayment, free cash flow, optimize spacing, better performance, and better returns. And all of that comes with higher prices. What is shocking to me out of everything that Miss Granholm said that was striking was, this is the evidence we need to double down on renewables to take the volatility out of the fossil fuel market. And it's like the fact that she doesn't understand supply demand or how pricing would work, or that there isn't enough battery storage in the world to store enough power to rely on renewables is so unbelievably just idiotic. And it's amazing that these are our politicians.
Is it that she? Here's the trouble I'm having, because Fatih Birol, of the head of the International Energy Agency, and I can't shred them enough on because I'm really have a bone to pick with him as well. Because he's done the same thing.
They're not the International Energy Agency. No, they're the solar and wind agency.
Well, exactly, and he's doubled down on saying, this is not, this energy crisis we're feeling it has nothing to do with has nothing to do with clean energy, has everything to do with fossil fuels. And I've changed. I'm no longer going to say fossil fuels. This is the oil and gas industry, and it's oil and natural gas. And, I think when folks are, and the industry is not doing them any favors either of saying this is fossil fuels, because it's very easy to sort of, pick on these guys. And I think this is where Secretary Granholm is the thing that she missed, and what I wish the Bloomberg guys, and I have a lot of problems with Bloomberg in general because they don't push hard enough on their interviewees, especially on China stuff. I was impressed that they pushed back on her like they did, because she is laughing, and I thought it was really discredit to the American people who are paying a lot of money at the pump. And they cite that. They say, look, you have a third of Americans, or she said, I think she said, what, 1/3 of Americans are feeling this and paying 30% of their income is going to energy, right? Energy costs. And so she made it clear to be saying that this administration doesn't want to penalize these guys, except the policy of the administration to deal with what he says, this tripling of going down in OPEC and pushing OPEC to produce more oil, is ask them to produce more oil. And yet, and he's doing that because he doesn't want the American people to feel high oil prices. We are the largest producer of oil and natural gas in the world. And she conflated or mistook, or either she doesn't know the market, but she said this is when the interview, Javier was, I believe it was him, that was asking her about the ban on fracking on federal lands, which it is a ban. It's in climate change, the executive order 14008. It's written very clearly, and it's been implemented, and it's being actually fought against in court, and they've lost, and yet they still haven't opened up leases. And so he cites this ban of leasing, and she says, we don't have a ban. We don't have, these restrictions you cite. We have 7,000 leases that aren't being used. And she says the same thing that you said, which was if $83, if, 80 something dollars a barrel isn't going to get them off to produce, I don't know what will. And it's like, well, there's way more factors. It's the fact that they are being penalized from an investor standpoint. And it is really interesting to talk to you about this, because you and I have had many conversations on where oil companies should be, how much they should be producing, the fact that the rig count shouldn't be going up. We've disagreed on a lot of that. On many things we have agreed on. But this is sort of the investor pressure is, I think, the single biggest thing that's driving, we heard it from ConocoPhillips in the earnings call. I haven't got to go through every single earnings call yet, but I was really struck by the Diamondback call, because that they said it explicitly. They said they didn't view the oil market as constructive. They're keeping oil production flat, and that they were concerned about, essentially, they didn't say we're concerned about investor pressure, but they said investors don't want this. And investors don't want this because of a movement from a movement at the very top in the administration all the way down to the market. And you have this, it's very real. You have Janet Yellen and the Fed and everyone talking about climate change. This is permeating into the market.
Oh, absolutely. But I mean, I fully blame the Larry Finks of the world. And you can go up in every financial institution, but BlackRock manages 10 trillion of AUM, and Larry Fink is out there very actively saying we need to transition away. I found his comments in the last couple of weeks have been interesting because he's saying, well, what's happening is these public companies are selling assets into private companies, and then they're polluting more. And so I use the example of BP selling Alaska to Hillcorp, and Larry Fink. I mean, the irony that a guy who does all his life in public markets and can only control public companies through their shares is lamenting the fact that oil and gas companies are doing what they should, which is letting prices be high, letting OPEC spare capacity get worked down, letting inventories around the world get managed, and letting prices go up to $100 a barrel. Because unlike that CEO roundtable in 2019, where everyone came out and said, we think stakeholders are just as important as shareholders and the climate, and a company's job is not to make money. Bullshit. A company's job is 100% to make profit. And I like $80 to $100 a barrel oil for profitability. And US companies would be idiotic to try and ramp up into that space until a whole bunch of other factors come out. So I love the setup. I still believe all oil and gas companies are massively overvalued, which is a problem. But then Tesla is like 1,000 times overvalued relative to Exxon. So
right, and you have the market. That's the thing, is you have the market overvalued, and this gets into I don't want to segue away from this just yet, but you have the market overvalued, and I think that she does not. The fact that Secretary Granholm is explaining this to people, and one, you have the Biden administration saying, and they've tripled down on asking OPEC to increase output, which they didn't, and we can talk about that. Then you have Secretary Granholm that's basically reiterating the same thing and blaming OPEC for these high prices, and it's not just high oil prices, and I can't get across to my clients and to investors and everyone I work with and talk with and people listening to the podcast enough that high oil prices, high energy prices, and inflation together are not something we have seen in my lifetime. And I think that is just extremely important to realize that in 35 years, you haven't really seen it. We've had high oil prices and we had little bouts of inflation, but nothing like this. And it's the speed at which we've had inflation, right? The escalation in the prices, the trillions sloshing around the global economy, the third of all the money in the system being printed since COVID, and like 25% of it being printed since we've had vaccines. And so it's like banana land we have all this inflation, and actually that CPI, the consumer price index that you can see on the Bureau of Labor Statistics, when you pull out just like gasoline and energy prices and electricity and natural gas piped, you see that it looks way worse because they block out in gray. They have the bars that I'm going to show my clients. It's the gray bars that show recession. It looks worse than 2008, folks, like way worse than 2008. That's scary because in 2008, we didn't even have quite the inflation. We had this big price spike. So I understand where you're saying the $80 to $100 oil is great for the oil companies, but I think if it was just that, if it was just $80 to $100 oil and the companies didn't have all this ESG monkey BS on their back, I would say it would be a little bit different. But I think it's the ESG monkey on their back that's weighing on them. And I think lots of companies can make money at these price levels. If you cannot make money $80 oil, you should not be in the business, period. I mean, this is a money-making market. And I mean, companies like EOG they're making lots of money. They are the shale industry, it's being debunked that you couldn't make money in oil and gas. Now, if you think their valuation's too high, I mean, the whole market's too high and that needs to come down. But this is like banana land. When, you can make money, you should be, I think if you're an oil company and you're publicly traded like an Exxon with that investor pressure that they've had. I mean, Exxon and Chevron and Shell have all reverted thinking and policies that they've had internally on oil and gas production. And they all did this within their last earnings call in response to the big fallout that they had in May, all in the same day from investor pressure. And so the idea that I think the market is not really internalizing the role of investor pressure, and they're not realizing that where does that investor pressure come from, how does it originate, and that it's politically driven and it can change. And I keep telling them, there's an evolution of investor pressure, and this. You worked at these companies. I mean, we told these guys to buy into the Permian. All the investors said, buy into the Permian, go bananas, any cost, who cares? Just get in there. And then we said, be free cash flow positive. And now we're saying, and go hit these whatever ESG metrics that we haven't told you what they are. We haven't defined them. We haven't qualified them. We haven't quantified them. But go do it, because otherwise you may not get into this fictitious long only basket that we have out there that you're probably not going to get into anyway.
Well, I really believe that the thing that's on the back of people's minds, it's certainly on the back of my mind, is when you see some of these financial institutions and financial money managers almost saying, we want to change the lending standards, that if you're involved in oil and gas, for example. So I think I believe that there's not anywhere near, as you know, companies should not trade at 7 times cash flow because it's not related to their inventory, and that there are only so many wells these companies can drill. So fundamentally, when I say 80 to 90, it doesn't make the companies worth more. It makes them worth relatively more. And companies should by now know that we live and die by what OPEC decides. 2014, 2016, 2020. We just have to let prices be what they are. But in the back of these guys' minds, like I think Scott Sheffield and Mike Wirth, what happens if they pull $100 billion of debt and they say, we're no longer going to loan to you, and you have all these investors coming into your stock telling you to go do 8% renewables instead of 100% Permian wells? I too would be buying back stock like EOG announced, like Chevron's announced. I would be paying down debt at massive rates so that the capital markets would have no influence on me. And I agree with you. All of those factors have to overlay in what energy prices look like. And yeah, energy prices are very, very high. And it's going to be millions will die this winter because A, there won't be energy available in some places. And B, tens of millions will go bankrupt because they will not be able to afford the energy that they need. If we have a rough winter, and even if it's not this winter, if it's down the road, I mean, it's if this winter is a slight, is warmer than expected in Europe or Asia, then some of these problems are somewhat alleviated. But I think that the seriousness of these high prices are huge, and the fact that these oil and gas companies, back to Secretary Granholm's comments, is that she says she can't do anything to impact the U.S. producers. Well, there's quite a few things that would lower oil prices within a flip of a switch. Biden and Secretary Granholm could get on TV and just say, we're rescinding that executive order we did on the ban of federal leasing on federal lands, that leasing. We're actually going to lease. We're actually going to do the leases right now. We're going to open that up, and we're going to actually look at the potential to build. We're going to talk to FERC, and we're going to look at the potential to add a pipeline out of the Marcellus, because we know we need natural gas. We know the world needs it, and why not get it from the U.S. as opposed to other countries? And we're going to look at accelerating permit approvals for LNG. Whether or not any of that actually happened, just signaling to the market that you are open for business would be enough to move. Guaranteed oil prices would slide $5, if not more, and that might come back when fundamentals reside. But the reality is that it would benefit, it would help. And so saying that we're not a part of it that we can't contribute is silly, because you say that 2014, 2016, all these times OPEC, and we have to let prices do what they are. We've impacted prices. U.S. oil production has been a massive influence on oil and natural gas prices globally, and we've capped the ability for what OPEC can actually do. And I am more of a proponent of stable oil prices around the 60 to 70 range. I think it's really healthy for the consumer, very healthy for the global economy, the U.S. economy. And I think that oil producers need to be pushed, and lots of things would have to shake out for people to make money profitably. But that's really, it's a healthy range. And it also prevents a lot of other crazy production from coming back. And OPEC, sorry, go ahead. No, I was going to say, but I mean, again, let's go back to the core, because we're talking about inflation. So the primary issue, and I know you will have talked about this with Rossano, because I know it's his like trigger button. You want to get him triggered. $80 billion a month is being spent on treasuries and $40 billion on mortgage-backed securities, when the housing market is up 50% in the last 2 years. Broadly
$120 billion a month. Yeah.
And so like, of course, I look at like Tesla, since they came out with earnings, is up 20%. They sold 637,000 cars. They make $5,000 of profit per car, and they trade at like 20 times, 25 times revenue when Toyota trades at 1. Their power generation business is not a profitable business, and their carbon credits are going away. And yet all this free money is like surging into Ubers and Airbnbs and Teslas. And so, of course, inflation is real because everyone has this money and there's no way to get returns. If we want to fix things, and so this is, to your point, I agree with you. That's what the government should do. But it would be acknowledging that they are 100% wrong on their climate approach, their budgetary approach, their COVID approach. So they'll never do it. But the only fix is to raise interest rates today to 2.5%. You'd have the market.
Or even less this interest rate thing, because I mean we had Jerome Powell speaking. I mean we had Jerome Powell on and I mean we should make sure we say a little bit of something about OPEC before we close this, because so much happened last week. It was amazing between Granholm and Jerome Powell and the jobs report and OPEC. All of this was last week, which is a crazy week. So interest rates, though, Jerome Powell sits there and I listened to the whole thing and the Q&A, and I was mind blown at how hypocritical this man. I am not a fan of the Federal Reserve. I am not a fan, though, of the administration swapping out Jerome Powell for somebody more progressive than he is, because they have 2 mandates and they can't handle either one of them. They're blown out on inflation. We have a 2% rough inflation consumer price index target, and we're at 5.4%. We're not going to hit that. And every month they're like, don't worry about it, because as long as we don't have month over month inflation, we've had month over month inflation every single month this year, and everybody's feeling it. And so he's like, well, that's not, well, basically they're saying we need to focus on employment. Well, employment did get a smidge better. We did trick down below. The jobs report showed that we went down below 5% for unemployment. So you're nearing this like unemployment thing. And all they did on the tapering side is reduce it by beginning asset. They're going to start reducing asset purchases from 120 billion a month by 15 billion. So that's it. 15 billion, only 5 billion for mortgage-backed securities. And the fact that we were putting any money into mortgage-backed securities from the get-go was crazy. I mean, they should have I don't understand the hesitation of immediately stopping or pulling on that. And they want to make sure that they think this is helping when it's really hurting, because if they wanted to help the administration, they would, and they wanted to help the economy, they would have started tapering earlier, because the market would have reacted a little bit, but then you wouldn't even have to raise interest rates. You would have tapered. And now you could have we raised them by 0.25%. You could slowly bring them up. But they're getting to this point where they're not going to have any, we're going into recession territory. We're going headlong into it. And then you'll have no tools in your toolbox you won't have any interest rates to lower. And you'll just say, oh, well, do more asset purchases. Well, you can't, because we already have too much money sloshing around the system, to your point. So there's not a whole lot of tools left. And I don't think people are really appreciating that, because, we're going to have to raise interest rates. No matter how this spins, we're going to have to raise it. And those interest rate raises are going to impact all this green tech in general. I mean, Cathie Wood's portfolio is going to look disastrous. And that should already be starting to get priced in. I don't agree with her portfolio from the beginning, and I don't agree with half the folks that are still doubling down on China with sort of the same idea of that, we'll just live through all this stuff. It's not a big deal. But interest rates alone, even as they start creeping up, people used to worry about that for oil and gas companies, as they won't be able to afford it, and interest rates are going up, and this is green tech. And the reason I say this investor pressure and this inflation is so important is because it weighs down to the private sector. It weighs down to the folks that I work with and do business with that are private. And I work with public companies as well. But the private guys are, they're in the field and they're doing this stuff. And some companies, thought that they were going to get bought out. They had an idea or conception that they might be bought out, and if you have great rock in New Mexico, why wouldn't you think you'd get bought out? And now they're thinking, well, maybe we never get bought out. And that's because I think this concept, and these are multiple companies. You could probably talk to any private New Mexico company, in the Permian Basin and ask them point blank, do you think you're going to get bought out? And the answer is probably going to be no, because of all that investor pressure and stuff weighing on these public companies. And sorry,
so I actually go a different way, obviously with One Energy and just thinking about New Mexico in particular, and thinking, you look at Continental's transaction for effectively the Jagged Peak and Parsley portion of that transaction, so that Pioneer pulls out of the Midland Basin. It's only a $3.25 billion deal, and Continental needs more. And so to your point, there's 3 people that are sizable enough, Ameridev, Taprock, Colgate, that fit that. And Continental, broadly speaking, now has a lot of cash flow, needs to move out of the Bakken because obviously they've been over drilling it. They're not probably going to be the successful bidder for the COP package. They're probably not going to get Exxon's position. And so they go and bolt on a private who has ramped up to 7, 8, 10 rigs, gets to 100,000 barrels a day, doesn't have to worry about cash flow, and then they just turn their shares into an accretive transaction. I actually think that this new game of Felixizing, I'll use that, I'll make that word up, of ramping up and selling a massive cash flow stream and allowing the company to use equity and then bailing out of that equity within 6 months, I think is brilliant. And we're going to see a lot of those transactions, I would think, in the next 6 to 12 months, unless oil goes back to 50.
I've heard the same. I have heard similar that some people think that's kind of the trend we're going. I haven't actually heard it happening. And it feels like there's still gaps between a bid-ask spread and people's thinking on the ground. And I mean, there seems to be some wideness there. And yeah, markets, the stability in markets matter. And I do think I do think the role of, I mean, the reason I bring up the inflation or the interest rate and inflation and investor pressure is that what happens if and when interest rates rise, because we haven't really been in this environment with this inflation, high oil prices, and this weird thing going on with oil companies and ESG and everything. So what happens when we have to, the Fed realizes by December and January and February that, they're forced to raise rates, and they'll do it by a tiny little bit, but that's still going to matter to the market, right? Interest rates are going up. What happens is that impacts tech, that impacts green tech, that impacts ESG. Is there any kind, I think there have to be some policy stuff to change with it, which I don't think is going to happen. But is there any kind of pressure shift or momentum shift that starts tilting investor pressure a little bit more in favor of saying, okay, green tech and tech isn't going to work all the time, so we're going to have to start thinking a little differently, and oil and gas isn't quite as terrible as we thought it was?
Yeah, well, 100%. And I've been saying this for a couple months now. I'll stand by it. Millions will die, millions will freeze, and tens of millions will have to spend 30 times. I mean, and we've talked about this. XL Energy had 10.4 billion of 2019 because the cold freeze was 2021. They had 10.4 billion of 2020 revenue, and in the 4 days, despite being hedged and not even in the Texas market, they spent 1.2 billion cash to buy natural gas to backfill for energy. That's 10% that utility prices went up. Plus, they're building $7 billion worth of transmission in solar and wind to get to Colorado's 85% renewable standard by 2030, which they're also making a 10% return on, which is 700 million. So you add 10% plus 7%, and utility bills are going up for 4 days, 20% in Colorado. So it doesn't even need
they're trying to figure out how to. Sorry, go ahead. Keep going.
It doesn't even need to be that cold. And so when people realize that they are going to die, people are going to start going back to fossil fuels. They're going to go back to coal. And Bjorn Lomborg's been doing a great job, and we need to get the word out. The energy transition to meet Biden's net zero goals, which net zero is also total garbage. But to get to the net zero is going to cost each and every American $11,300 per year for the next 29 years, which means we're going to be paying $350,000 of cash per family member for an energy transition that may or may not change 1.5 degrees Celsius. And if you told people that, you would probably say, I could do for 2 degrees warmer. I don't understand why we're trying to stop warming. We should be trying to manage warming. That's it.
Well, that's I think where, and I talked about this with Chris Wright at length in the podcast I did with him, but I think this is where, and I really do encourage people. I'm going to get Steve Koonin on the podcast. I think, Bob McNally with Rapidan actually just interviewed him as well. And Steve Koonin was at Liberty's Investor Day, and I met him. But that book Unsettled is fantastic in that there's, the major sections in the book really just talk about, I mean, he's a pro climate change guy. He doesn't disregard that it's happening, but he basically just, I mean, the thesis of the book is your ability to actually measure it and be accurate in that of what you're doing and impact it. And I explained to folks that International Energy Agency report that did the IEA net zero report that came out this summer that said no new investment in in oil and gas, no new investment now, beginning now onward in oil and gas investment, which by the way, they said that again just recently in the World Energy Outlook. And then in their oil market report released within days at the same time, they said oh, by the way, you need to be investing in oil and gas. So they're just speaking out of both sides of their mouth, which is just, it's absolutely ludicrous. And it's really hard to swallow. But the point is that net zero report has a 52% probability of actually working. And no one says like, we're all going off the UN IPCC, what their things are for 1.5 degrees. And it's not hard to ask questions of sort of like, well, what's the year we're starting from that 1.5 degrees Celsius, and when is that going to increase? And I think that's where it gets a little bit tricky, because that's what Steve Coonan brings up, is not that this disregarding, it's just where are you starting from the measurement standpoint. I tell people, look, from a risk analysis standpoint, and forget the politics of it. I'm not here to debate climate change. I'm not here to do that. I'm explaining that when it's policy driven, and when you're telling people that you're going to have to pay all this money and do all this stuff and make all these sacrifices, which they don't realize they're going to have to make, and then it costs them a fortune. I mean, it's IEA's numbers are trillions, 4 trillion every year between now and like 2026 and 2030 is trillions a year. There just isn't enough money for that. I mean, and it will bankrupt countries, bankrupt people, bankrupt economies. Like, it's going to be devastating. And then it's the probability that you would even do the thing that they say, which is get to net zero of the 1.5 degrees Celsius from a predetermined date. And then what happens what happens in 4 years when everybody spends all that money, and Excel has said we're going to increase rates 13%, your utility bill going up, and call it 13%, which is going to kill families. I mean, with the other inflation that we have now at the grocery store, these people are going to be impoverished, and it's going to be devastating. So with that, if the weather doesn't change, if weather events continue, and you can turn on, it's no different. I did a criminology minor, and I tell people this because it's like in 1994, it was the summer of violence, and everybody said this is not bad violence, and it was all over TV, and it was crazy, and violence had actually, like, crimes had actually steadily declined, and it was getting safer and safer, but it was very publicized as it was. And I think every time there's a hurricane, every time there's a weather event, it's climate change and disaster, and it's a fear tactic to get people on board with this stuff. And so regardless of whether every weather event is climate change or not, if you don't change the weather, which they might not be able to, then, and the people don't see that. I mean, you have these county commissioners in Boulder saying the snow melt's going to go back to exactly what it was, from whatever date when we get to net zero in Colorado, which is just saying that one, we have CO2 emissions have borders, which they don't. So it's all, all of this is hell bent on one single thing. And I just don't think it takes a rocket scientist to believe that, it's like, this isn't going to work out. It's politically driven, and it's going to the economics of the system and the economy. And when people realize that it's not working, and they're paying a fortune, it's going to break.
Well, and I think you touched base on it, right? When you talked about the elections in Virginia. I mean, Biden carried New Jersey by 16%, and Murphy looks like he's going to win by 0.2% over the Republican candidate. They lost Virginia. They aren't able to put some of these policies, because, again, if you look at the infrastructure bill, and I think regardless of whether you're Republican or Libertarian or a moderate Democrat, Manchin is doing like God's work, because he's identifying the fact that, like, you can't just cut off a program 5 years early and then be able to retwiddle the numbers to drop things, because once entitlements are in, they're in. And so, I mean, I think that Democrats are in a huge amount of trouble in 2022. I think that Biden's mental health is obviously deteriorating at an unbelievable clip. And if you get a huge Republican win in the Senate and the Congress, and then 2024, I mean, I think you can see us move. You think we moved away from the Paris Accord before? I could see us just trashing all of these guidance, because we'll have had 3 winters between now and 2024 that show us how bad it is when we don't have energy. And the conversation will be about trade-offs.
Except the problem is, and I don't want to get into politics too heavily, but we had a lot of Republicans vote for this infrastructure bill. And Joe Manchin, I have to say, he is the MVP of energy and basically anybody who's modestly fiscally conservative. He's your most valuable player right now, because he said in the same, he was being interviewed, and he basically said, why can't we produce more energy at home? Why are we beholden? He basically said, we have a pool of natural gas under my state. Let me produce it, and we'll help solve this problem. And he's 100% right. And you can control, if this is about emissions, which it's beginning to it can't really be about emissions if, the U.S. oil and gas production contributes only 1% of U.S. emissions. And yet all these companies are killing themselves to hit these fictitious ESG targets. and then, hoping that they'll end up in a long only portfolio and their stock will go up, not thinking about exactly what the 10% capex they're spending on all this ESG stuff and whether or not it's gonna give them a return on the investment. I mean, I wouldn't say this is the come to Jesus moment, but it's just a reality is that you can produce this stuff at home, and if you can actually produce it safely and cleanly and with humanitarian standards, and it's needed. And the natural gas being a core element to this, which, when Secretary Granholm said this was about, she said this is a global gas market when they were talking about oil. It's not a global natural gas market. I mean, we do influence natural gas prices on the spot market because we export around 11 BCF a day. But this is a global oil market, and we also influence it with our oil production. I mean, we could increase natural gas production and impact global natural gas prices. Not a ton. It's not going to be the same if we did oil, but you could, if we rose oil production 500,000 barrels a day, we're going to impact the oil market just because we're going to spook OPEC. And I do want to pivot 1 second and go into OPEC before we switch into closing out the stuff. So OPEC Plus did have their meeting, and so I think it makes the administration look incredibly weak. I don't care if this was a Republican administration or a Democrat one. If you were calling on Mohammed bin Salman, you're calling on OPEC Plus to increase output, and you're begging them for like the third time, and they don't do it. One, it's showing that, and the foreign minister for Saudi Arabia has made it clear. He was on CNBC earlier this week, CNBC World, and he said, we haven't heard from him. So they're saying we're not hearing from the Biden administration. The Biden administration is using, the media to talk to them and saying we're calling on them. And it makes the U.S. look weak to be asking for, these countries to increase output when they're basically said we're increasing 400,000 barrels a day every month. They still have, probably 4 million barrels a day that they've continue to keep off market, but they're going to add these barrels back. And anyone who thought that they were going to add more than that, they're not. It's not smart for them to be like, oh, okay, Biden, we'll just go increase output because you said, even though that could create more volatility in the oil market. And given that this oil price increase, the most recent surge, is not about oil, it's actually about natural gas, and not these countries really not having enough storage of natural gas in hand. And so I don't really, I'm not defending Mohammed bin Salman or Saudi Arabia or members of OPEC Plus necessarily, because I tend to not agree with them on many things. However, they're right here. I mean, they can't, they're not, unless they're adding natural gas into the system, this really isn't going to solve it. And it also just shows that the whole system is broken and ridiculous and nobody wants to publicize it, certainly not Secretary Granholm, that people are burning. We still use heating oil in the Northeast. People are burning diesel. I mean, those prices are going to be ridiculous this winter. And in the U.S., prices will be high because of higher natural gas prices. But abroad, they're burning oil instead of natural gas in these power plants and they'll be doing this all winter because they can get the oil and they can't get the natural gas.
Yeah, and I mean, I think that ties to BP, although I don't know if I really believe BP because they're no longer an impartial observer any more than the IEA. But they did say they think global demand is back to 100 million barrels a day. And again, I would quote Mark Rossano. I think he talks about right now floating storage of oil is kind of back to all-time highs. So I mean, structurally, I agree. OPEC, why would you sell your barrels at 50 instead of at 80 when cheating will occur? There's still an open question on how strong the economy is when developed nations start raising interest rates and going into a winter where it might be a total disaster. And I agree, it is about natural gas. It is about oil switching. But I still think there's just so much free money that's speculating on things. And again, for Tesla to add 200 billion in market cap on 100,000 Hertz cars effectively and earnings, Toyota sells 12 million cars a year, has 284 billion in revenue. Tesla sells 850,000 cars a year and has less than 50 billion in revenue and trades at like 25 times Toyota's multiple. It makes no sense. And so with these financial guys just chasing like the casino, it feels like 2008. It feels like 2000.
Yes. And this exactly. This feels like. And you can see it, especially, I mean, it feels like, and I tell people, like, what happened in the early 2000s? Yes, the market continued to run up. What happened in 2007? It continued to run up. And the data's out there. The things are out there. If we just had inflation, if we just had a high oil prices, if we just had this stuff going on within China, one of those things would be enough to get people's concern. But we have all of them. And I do think that the high oil prices in the context of this global economy, people keep interpreting this pent-up demand as this I want to say they interpret it as like real economic growth. You forcefully artificially shut down the economy, shut people in their homes, and they stop driving. And then you open it back up. People do have pent up demand. They're driving and they're seeing people. And we've had incredible, resilient gasoline demand in the US, which has helped offset significantly oil demand in the US. But people had this previous thought where, oh, we'll never go back to normal. We'll never go back to those numbers. We adjust and we eventually go back to things. That's what's happening. China has not started flying yet internationally. When that happens, you're going to start seeing, obviously, oil demand will go back to those levels. However, this pent up demand, it's like, how real is this? I mean, I think when I was talking with Mark, it was kind of like, well, look, how many months of data are people just going to just say, we're going to eat this inflation, right? We'll just keep eating it. And I think part of it is it's this holdover from the pent up demand of, well, we haven't eaten out much because we didn't before, and you only live once. And so you need to do this. I think it's we're going to feel this impacting the consumer, and they're not going to feel as good about, these high energy prices and inflation, unless they get under control, are going to impact things. And I think abroad, particularly in China and India, where in these emerging markets where oil demand has just gone like this, regardless of price over the last several years, it's a real concern. It's that prices are going to begin to matter. I'm not saying right now that people are changing their behaviors, but we even heard this over the summer. The Asian markets are feeling it, right? It's not, you're going to impact oil demand growth, and oil demand growth tends to impact oil prices. So maybe we just cap out of this 100 million barrel day market. And that's just reality. I don't think we're declining demand, but I think the recession risk is real. And I think the global economy is way more vulnerable than people realize.
Well, I'll tell you what my biggest issue is the Fantasyland games that television's playing, right? So I have two stories. I met with my Wells Fargo advisor, our annual thing, and they're like, don't worry, the economy, it's growing. It grew 6% in Q2 or whatever. And I said, okay, but you understand you're comparing to a baseline of when things were shut down. So I go back to Q4 of 2019 when the S&P was 3,000 and the US economy was 19.5 trillion GDP. And right now we're like 19.8. So we are above 7 quarters later. We are above what we were in Q4 2019, but the stock market is also valued 60% more. And people are spending things that they haven't spent the last 7 months or 17 months or whatever. So that is insane. And then second, I'm part of an investor group, and we bid on a house in Denver. It came on the market Friday. The bid deadline was Sunday at 10 a.m. We offered 7% over list, cash in bags, delivered to the house 2 days after the bid deadline. Zero inspection, zero contingencies, zero financing. Literally 7% overpay would have dropped bags of cash on Tuesday, lost by 10% to a similar option. So the house went 20% over market in 3 days for a really, really, really shitty house. And like that is the problem. And it can only be fixed by the Federal Reserve, who, like you, I have zero faith in. And they are ignoring all of the symbols that say that this economy is overheated.
And that's your post. That's what got my attention on the housing thing, because it's very real. I mean, these housing prices are out of control, and the bill, even if you could afford it, and I think a lot of people are getting stretched thin. So that's another whole thing. And I mean, people are you walk around, you look at the couples that are looking at the houses and buying houses, and I mean, they got the scare face on of like, okay, well, I guess we're going to buy this for $800,000, whether we can afford it or not. And well, guess what? If the economy doesn't look as rosy and things get a little thinner, and I do have a question to you, because I want to get this back to this jobs thing before we close it, and I do want to ask about this the housing market when we think of China and Evergrande and their housing market compared to ours. But so these people are, I mean, nothing is going to solve this housing bubble unless we have higher interest rates, right? Mortgage rates have to rise in order to cool this down. And the global economy cooling itself, or the U.S. economy cooling, could do some of that, right? Because people just aren't going to buy this. But these investors, this money sloshing around the system, that's screwing over the average person being able to buy these homes. But the jobs report basically said, hey, we have and this, the Fed's going to be in trouble with this, because the jobs report, unemployment came down below 5%. And it's still very sticky. Things that we have, I think, 4 million people that have not re-entered the workforce, and no one can understand. Are they basically on CNBC? The discussion was, are there's a couple reasons why they wouldn't, and it's because they just retired and they're living off savings, or there's still enough benefits in the system. And I think there's been a lot of confusion on, I think, when the unemployment benefits rolled off, the extension of the big extra package. People were getting like $400 extra, I think, a week or something like that, or a month. It was a huge number. That's where we saw it over the summer.
It's 400 a week. Yeah.
400 a week. Yeah, which is, I'm sorry, it's insane. It's a lot of money. So that was your extension. That has rolled off, but it doesn't mean that unemployment has completely rolled off. And I don't think all the benefit, like the things are still sticky within the system, because I was in Pennsylvania. I was at a Hilton in this outside of Pittsburgh in Cranberry, and I'm at this Hilton, and I go in there and I ask for my room, and they put me right by the road. And I'm like, I don't want to be picky, but I'd love something a little quieter because I just desperately need some sleep, and I'm a light sleeper. And he was like flustered because he's like, we only have so many rooms open. I was like, anything that's quiet. And so he moves around, and I asked him, like, what do you mean you only have so many rooms open? He's like, yeah, we only have a handful of the hotel that's open because we can't get any cleaners to clean.
Yeah.
And he explained to me that people interviewing for the front desk job positions at the Hilton in this town he said they have no experience, and they expect managers' pay. And he was like, they expect what I'm getting paid, and I run this thing. And it was insulting to him that that's what they expected with no experience. And because he had done, he had put in the work and the experience. And I was thinking, when I heard that jobs report, literally the next morning, when I'm in the hotel, I mean, and thinking about what the Fed said, what Jerome Powell said, of that, we do have to be concerned if wage increases keep going up, that's problematic. I mean, it's huge, because as a small business, and I am a small business, and I would love to hire a couple people, but I absolutely couldn't afford to right now, especially because there's no way I could get somebody at a reasonable price that's probably reliable, and those prices are going up. So if you're a small business and you want to grow, you're screwed right now. And America's built on the back of small businesses. So the growth there, I think, is going to be very, very painful.
Well, I mean, but I think that there's so much to unpack on that. So I filed, because I filed an extension because of all the K1s I have. So I filed a tax extension. So I had to file it October 15th. And my tax guy said, I got $8,000 of stimulus. And I get the child tax credit for
What?
like whatever. Yes, there is no reason. And so again, I don't even know if 8,000, I mean, it's obviously a lot of money, but like for someone who was working at a restaurant making $15 an hour, $10 an hour, whatever, $8,000, if they have no saving proclivities, they can't go buy a house. And the eviction moratorium, which I'm also an investor in a building in Ohio, and the eviction moratorium effectively meant that tenants just didn't pay for 5 months, saved $7,000, and then just left, and they never have to pay it. So there is this latent excess cash in the system that
100%.
non-savers can rely on, and that we're seeing manifest in terms of no jobs. And you can see it in the difference between the unemployment rates in red states versus blue states. That's definitive. I think, it's going to be crazy. But you are right. On the investor side, the fact that I'm trying to buy a house, our Airbnb in Arizona is going to do a cap rate of around 10% this year. And so when I can make 10% on a house by Airbnb-ing it, I'm going to go buy multiple houses, not live in them, rent them to other, fancy Airbnb, because that's where you get the most money. And it is taking inventory out of the market that's hurting, the working families. So we have totally set this up for ourselves, and it is going to crash horrifically badly.
Because what happened in 2007, 2008? Most people had multiple homes. And, I had a hard time crying for people when it was like, well, they're protesting. And I'll be very honest with this. When people were protesting on Wall Street, young people were protesting, and they were rich kids but they had to take a gap year in college because their parents had 4 homes and it lost 3 of them. And I thought, okay, well, maybe you shouldn't have bought 4 homes. But that's what's actually happening right now. And things can change. Yes, interest rates are low and they're fixed, and it's different from these adjustable rate mortgages. But, there's this thing going on in China of many, many, many things going on in the Chinese economy. And they have they have a real housing crisis that's going on. That's front and center. We just don't hear about it because media doesn't not cover it well at all. But I mean, our property sector when we crashed and took down the global economy was 1/5 of the U.S. economy, roughly, and our housing sector. And in China, the property sector is roughly 1/3. I think it actually could be a little bit higher given all the knock-ons, but it's roughly 1/3. And everyone knows that it's it's not just Evergrande, it's every single little company. Country Garden, all these companies. You're going to turn on Bloomberg tonight, turn on CNBC World tonight. That's what you're going to hear about. Is more of these companies that are more of these real estate agencies that are going under. And the problem is, these folks have been out of they haven't been building. They've been out of work for a long time, and so it's not just them not paying bondholders on foreign bondholders. It's that what's going on within the actual system, and they are a huge economy within the global system. And if they slow, not saying it's exactly like the U.S. where it trickles around the globe, but if they slow, it certainly slows things down, like energy consumption, like oil consumption, or potentially, and which will slow down, which could impact oil prices and could impact the global economy.
Again, there's all these risks, and the last thing that I would touch on that we're not even talking about is the OSHA mandates. And I use Walmart. I use Walmart. Now, I do agree with Ben Shapiro on this one, that similar to the CDC eviction moratorium was not legal. The Supreme Court ultimately ruled that it wasn't legal, and it was just to be able to say to the voters, we did this. I do believe that this OSHA guidance is such a broad overreach of unconstitutionality that it will ultimately not pass. And therefore, the Democrats will be able to say, well, we did everything we could, and it got stopped by Republican judges, and it got stopped by this, but we tried it. But Walmart has 1.6 million workers, of which, even if you use the federal, national average of vaccinations is 70%. So even if you said that the low income wage earners who have a lower vaccination, but at 30%, that means 533,000 employees need to test weekly for $30, which means that Walmart will have to pay for those tests most likely, which is almost $1 billion a year Walmart will be spending on testing. That is not sustainable. And when you see Southwest canceling airline flights, American canceling flights, and if my company goes to a vaccine mandate and test, I'm going to make a stand. I could pull an Aaron Rodgers and just go through the testing, but it is so non-scientific and so irrational to force people to test, and then they're testing negative, and you're making them wear a mask when they've already proven that they are not the ones who are passing the virus. And vaccinated and unvaccinated can catch and spread. This is where I draw my line. And I think that a lot of people will leave the workforce temporarily and then think about the supply chain challenges. We
didn't even get into any of the supply chain thing, which is all a whole knock on of the jobs thing and the shortage of truck drivers and all kinds of issues things. It's a whole nother podcast on supply chain. But this thing on I think people don't want to talk about, because it's controversial. People don't want to say, well, do vaccine mandates actually impact employment? And I think it's very clear in places, police force in Chicago and lots of places, they are impacted and people are quitting their jobs. The quit rate is very, very high. The Fed admits this. We're hearing this in the Beige Book and stuff. And so vaccine mandates are impacted this because certain people don't want this. The other problem is that, I think it's Pfizer and Merck both now have a pill. And so it's like they both have a pill to treat this. And so you have a lot of folks debating on whether or not, where are we going to go with this? And it's like, well, if there's a pill to do this, it's kind of like game over in the US. But then you still have, and I think I'm just quoting because I'm not trying to bias anybody on this, but the Potomac Watch, the woman that's on Potomac Watch for the Wall Street Journal, she's a good analyst in terms of spewing this stuff back. But what happened within the election on Tuesday night, and I truthfully say this from a economic risk standpoint for your businesses, you have to follow politics. You really do, because it's impacted the economy. It's impacted stuff so much this year, especially from an investment standpoint, and it impacts your trajectory of how you run your business going forward. And what happened on Tuesday night when I saw Politico and CNN just pop up on my Apple News feed was like, this is not, it basically, both of them summarized it and said, the loss on Tuesday was not about a referendum against Biden. It was really that they wanted him to do more, not less. And I thought, no, there's not a first chance in hell. The loss on Tuesday was about simple things like inflation and the fact that it was saying we are we voted in a guy who we thought was a moderate, and we were told by the media that he was moderate. We voted him in, and it's been progressive all the way. And I have to tell people that this is not, I mean, we do have real communism in China. We do have more socialist governments in Europe, and that is that social spending. So what this administration has tried to do is pass social spending. We didn't have real concerns about inflation until Biden came into office because we didn't have entitlement programs as part of the stimulus packages. Now we do. Entitlement programs don't go away. You continue to spend in them forever, and they cause real inflation, entrenched inflation. And that is what's got Jerome Powell in a really tricky spot, because he has to admit, and he would have to admit that the politics side is impacting his job and it's not making it easy. And he is in a very, very tough spot because those entitlement programs are very real and that spending is real. And it's they've spent all the money, but the fiscal side has spent all the money, and the people are not happy. That's it. I mean, the people are saying that this is not what they want. And Manchin is saying, yeah, I'm not going to go for it. And by the way, we want to produce more energy here at home. And he's a Democrat.
We are in a pickle. And I'm glad that you're chatting about it. I know I'm chatting about it. And maybe they'll make a movie, The Big Short 2. But the key will be, we'll have to bet. And I will tell you, I will acknowledge I went short energy last week.
Really?
Now, I was amazed that oil moved from 85 to 79 and my short went up like 1%. So I can't exactly explain why oil would trade off 7% and the companies are still basically flat to it. But I do see, I mean, it's going to go, like as everything goes, I think we're going to see the market have a correction in the year end. Personally, not investment advice. And I think that the energy complex at 85 oil and 550 gas feels rich for what the world needs. To your point, inflation is high. That's bad for the economy. It's bad for spending. It's bad for the reopening. I think that, we're headed into winter. We're going to see cases rise in COVID. There's no doubt to me, like we see the efficacy. 2 of the 3 are below 50%, which at least as I do the math, says you're more likely to catch COVID than not when you're below 50%. Broadly speaking, there's a lot of bad news that just everyone's glossing over. And I'm thinking the next 45 days is going to be pretty painful.
I think that's a great way to summarize the podcast. So I think that's a very good way to close. And I don't tend to disagree with most of those comments. I think that the oil prices, when they backslid a little bit to 79, I didn't want to hone and harken on, but I just kind of tell people, especially clients and especially people I talk to and just like pick up the phone is, yeah, when it can do that, it tells you something, right? It tells you that, okay, we had a little bit of a stock build 2 weeks in a row in the U.S. For stockpiles, and it's the fact that we had any stock build, right? And then you look at the actual, we actually have very good data in the U.S. for oil demand, and you just saw like where did you see some of those like other oils? The category other oils for products supplied was down a smidgen, and that other oils there's just jet fuel in there. So we tend to, everybody's glossing over stuff. The data eventually comes out and it lags a little bit, but we see like, where's demand? Does demand get curtailed on things? And I think to your point, 45 days over the winter is going to be extremely important of how the winter sort of plays out. Doesn't mean that the market's not going to continue to trek higher and people aren't going to go crazy about Tesla and ridiculous evaluations, but that doesn't mean it's right either, or it's reflecting reality.
Well, speaking of, I am going to go add to jet fuel demand because I'm going to the airport to hop on
absolutely.
It is great to see you, Trisha. Thank you so much for the invite on.
Great to see you as well. Thank you so much. All right. Talk soon. All right. Bye.